Introduction. Have you ever placed a trade and then immediately felt regret, fear, or panic? Even if it was the right setup, you're not alone. Most traders lose money not because their strategy is wrong, but because their mind isn't ready. They exit too early. They hold too long. They overtrade. They get FOMO. They chase. They freeze. Sound familiar? Here's the truth. Trading is 10% skill and 90% mindset. And the market doesn't reward IQ. It rewards emotional control, patience, and consistency. This book is not about candlestick patterns, indicators, or magical entry points. It's about the real reason traders win or blow up their accounts. The mindset behind the monitor. The psychology behind every decision. The discipline to follow your edge, even when your emotions scream the opposite. I've written this book for traders who are tired of the cycle. Winning big, losing bigger, blaming the market, starting over. This book is the mindset system I wish I had when I started. You'll learn how to control your emotions during high-stress trades, build a process that protects you from impulsive mistakes, let go of ego and trade like a machine, not a gambler. Think in years, not minutes, and develop the kind of mindset that turns you into a consistent, calm, and confident trader. This isn't fluff. This is battlefield-tested mindset training. It's the missing piece in your trading journey. And it might just save your account. So, before you place your next trade, before you start, make sure to subscribe to our channel. Get more powerful audiobooks that help you become 1% better every day. Chapter 1. Mindset Before. Money Why 90% Lose Before They Even Place a Trade. The market is a mirror. If you're fearful, it will show you fear. If you're greedy, it will reflect greed. If you're calm, disciplined, and focused, only then will it reward you. Most traders lose. Before they even begin, let's be brutally honest. The game is rigged. Not by brokers, not by market makers, not even by institutions. It's rigged by your own mind. Before a trader opens a chart, before they press buy or sell, they've already made decisions based on their beliefs, fears, and mindset. And this is exactly why 90% of retail traders fail. Most people come to trading for one reason, money. But they stay broke for one reason, mindset. They jump from strategy to strategy. They binge watch YouTube videos. They fill their screens with 12 indicators. But they never pause to ask, am I mentally ready to trade real money in a high-stress, high-uncertainty environment? Because here's the uncomfortable truth. Trading isn't about being right. It's about being ready. Ready to accept uncertainty. Ready to control your emotions. Ready to stick to your process when nothing makes sense. The market doesn't care how smart you are. It cares how disciplined you are under pressure. What you believe shapes how you trade. Every trader operates from a mental blueprint, a mix of beliefs, assumptions, and emotional habits. If your mental blueprint tells you, I must win every trade, losing means I suck, I'll double my account this month, you're setting yourself up for emotional chaos. On the other hand, if your beliefs are, losses are part of the game, my job is to execute, not predict. Profit comes from consistency, not speed. You give yourself a massive edge over the competition. Most people enter the markets with a get-rich-quick mindset. They treat trading like a casino, one big win away from freedom. But pros, they treat trading like a business, with structure, process, patience, and most importantly, mental resilience. Why you don't need a better strategy. Yet. Here's what every new trader believes in the beginning. Once I find the perfect setup, I'll make money consistently. Let's break that myth right now. There are traders making money with RSI plus, moving average, pure price action, Fibonacci levels, supply and demand, even coin flips with proper risk management. And there are traders losing money with those exact same tools. Why? Because strategy isn't what separates winners from losers. Execution is. And execution is 100% a mindset game. The best strategy in the world won't save you if you hesitate on entries out of fear, you move your stop loss to avoid pain, you revenge trade to win back losses, you overtrade out of boredom. You risk too much out of greed. Until your mindset is aligned, your strategy doesn't matter. Your results will always reflect your inner world, not your indicators. The market exposes you, not rewards you. One of the most painful and powerful things about trading is this. It exposes every emotional weakness you didn't know you had. If you lack patience, you'll get chopped up in low-volume zones. If you crave control, you'll panic when the market does the opposite. If you have self-doubt, you'll second-guess good setups. If you seek validation, you'll listen to others and ignore your plan. The market is a brutal truth machine. It doesn't lie. It doesn't care. It simply amplifies your behavior. If you have unresolved emotional patterns, trading will bring them out fast. And here's the kicker. Most people blame the market, not themselves. They say, the market is manipulated. This strategy doesn't work. That guru misled me. When in reality, it wasn't the market. It was your inability to stay calm, stick to a plan, and trust your process. The winning trader. Identity. Before you win consistently, you must become someone who can win consistently. This means shifting your identity from gambler, probabilities, thinker, prediction addict, risk manager, outcome chaser, process executor, emotional reactor, calm decision maker. Ask yourself, if I was already a profitable trader, how would I think, act, and make decisions daily? Start becoming that version of you now, not when you make it. This book isn't about becoming perfect. It's about becoming mentally prepared to survive long enough to win. And the only way to do that is by becoming the person who accepts risk, detaches from outcomes, learns from losses without shame, respects the market, trades from strength, not emotion. Why mindset is the only true. Edge markets change. Strategies break. Indicators fail. But one thing never stops working: your ability to stay emotionally stable in uncertain conditions. That's mindset. And it's your only long-term edge. Think about this. Every top trader in the world has faced crippling losses, emotional breakdowns, self-doubt, market crashes, long periods of drawdown. Yet they're still here. Why? Because they built a mindset that could survive those storms. Mindset doesn't guarantee profit, but it guarantees survival. And in trading, survival is everything. From survival to success, a mental model. Here's a simple model to remember. Phase 1. Hope and excitement. I found trading. I'm going to be rich. Phase 2. Confusion and chaos. I keep losing. Why isn't this working? Phase 3. Overload and burnout. Maybe this isn't for me. Phase 4. Humility and reflection. I need to work on myself, not just strategies. Phase 5. Discipline and focus. I have a plan. I control risk. I'm calm. Phase 6. Consistency and mastery. I'm profitable. I think like a trader. I've earned this. Most people quit in Phase 2 or 3. Few make it to Phase 6. Your job isn't to shortcut the process. It's to build the mindset to survive it. And that begins now. What you'll gain by shifting your mindset. Let's get practical. Here's what changes when you prioritize mindset before money. You stop revenge trading. You accept small losses with emotional neutrality. You follow your plan. No more second-guessing or panic exits. You take fewer trades, but with higher conviction and clarity. You sleep better, because you know you managed risk correctly. You enjoy trading again, because you're no longer battling yourself. Chapter 2. Kill the noise filter, the chaos. Focus on the signal. The market is loud. Your mind can be louder. The financial markets are one of the noisiest places on Earth. Every second, millions of tweets, news headlines, analyst opinions, price, alerts, and social media memes scream for your attention. Brokers ping you with promotions. Traders on forums argue endlessly about what will happen next. You get sucked into debates about interest rates, inflation, geopolitical crises, and technical patterns. Sound familiar? This isn't just background noise. It's a tsunami of information designed to trigger emotional reactions. Fear, greed, FOMO, doubt. If you want to succeed in trading, you must kill the noise. Because here's the truth. The biggest risk to your trading account isn't the market. It's the noise inside your own mind. Why noise is your worst enemy? When you let noise control you, your brain gets flooded with conflicting signals. Is the news bullish or bearish? Should you buy, sell, or hold? Which expert do you trust? What if the market gaps overnight? Am I missing out on the next big move? This overload causes analysis paralysis. You either freeze, overtrade, or impulsively chase trades. Studies on decision fatigue show that too much information decreases the quality of your decisions. Your brain simply cannot process every piece of data thrown your way. Yet many traders feel compelled to stay glued to every news headline or market update, hoping to catch some edge. Ironically, this leads to increased stress, emotional trading, inconsistent results. Burnout trading is not about being everywhere at once. It's about focusing where it matters. The difference between noise and signal. To trade successfully, you must become a signal seeker, not a noise absorber. Noise is everything irrelevant, distracting, or emotionally triggering. It's the market, chaos that clouds your judgment. Signal is the clear, actionable information that fits your trading plan and strategy. Think of it like this. Imagine tuning a radio. When you're on the wrong frequency, you hear static, crackling, and chatter, noise. But when you find the right frequency, the music comes through crisp and clear, signal. Your job is to find your trading frequency and tune out everything else. Step 1. Cut out the noise sources. Where does most noise come from? Here are the biggest culprits. Financial news outlets with their sensational headlines. Social media, Twitter, Reddit, YouTube, full of opinions and hype, trading chat rooms and forums filled with speculation and emotional rants. Unfiltered alerts and notifications from apps and brokers, overanalyzing multiple timeframes and indicators. How to kill the noise. Limit your news sources. Pick 1-2 trusted, reputable outlets and check them once or twice daily. No more. Avoid constant scrolling or refreshing. Mute or unfollow toxic social media accounts. Your mental health depends on it. Set strict trading hours. Don't stare at screens all day. Take breaks. Step away. Turn off non-essential notifications. Your phone should be on your terms, not the market's. Stick to your trading plan. Don't chase hot tips or jump between strategies. Trust your process. Step 2. Create your trading routine. A noise-free zone-top traders don't react to every new piece of data. They build structured routines to maintain clarity. Consider this routine. Start the day by reviewing your predefined watch list or setups, not random stocks or currencies. Check economic calendars for major events, but don't obsess over headlines. Spend 15 minutes max reviewing charts with your strategies checklist. Journal your plan for the day, entry, exit, stop loss, and risk amount. Trade only when your criteria are met. End the day with a review. No last-minute trades. Routines like this train your brain to focus on quality over quantity and reduce emotional impulsiveness. Step 3. Build emotional immunity. To noise. Noise often triggers emotional reactions. Fear, greed, impatience, and doubt. To build immunity, practice mindfulness. Even 5 minutes a day can help you observe your thoughts without reacting. This strengthens your emotional control. Use breathing exercises during stressful moments. A deep breath can interrupt panic. Recognize emotional triggers. Is a news headline causing you to want to jump into a trade? Pause and ask, is this part of my plan? Visualize yourself calm and disciplined before entering trades. Mental rehearsal builds confidence. Step 4. Develop independent thinking. Trust. Your analysis following the crowd leads to poor outcomes. The market is a zero-sum game. For someone to win, others must lose. Independent thinking means forming your own opinions based on your plan and research, not chasing hype or hot takes, avoiding emotional contagion from others, fear or greed, having the courage to stand alone if your analysis says so. Remember, the market does not care about your social proof or how many followers you have. Step 5. Simplify to amplify. One of the greatest paradoxes in trading is complexity often destroys clarity. Many traders try to add every indicator, chart pattern, or news source to their screens. They believe more data equals better decisions. In reality, simplicity is the ultimate sophistication. Simplify by choosing 1 to 2 key indicators or setups you understand deeply. Limiting your watch list to a manageable number of assets. Using clear, defined rules for entries, exits, and risk management. Avoiding multitasking. Focus on one task at a time. When you simplify, your brain can focus on what truly matters and avoid cognitive overload. Step 6. Use technology to your advantage, but don't let it rule. Technology can be a blessing or a curse. Automation tools can help filter signals and execute trades. Alerts and scanners can save time looking for setups. News aggregators can condense headlines into key points. But beware, over-reliance on tools without understanding. The why leads to blind trading. Constant pings from apps keep you emotionally reactive. Endless chart scrolling is a form of procrastination, disguised as research. Set boundaries with technology. Use it to support your plan, not replace your judgment. Real trader story. How killing the noise changed everything. Let me share a story about Sarah, a trader I coached who struggled with overwhelm. Sarah used to wake up every day glued to her phone. She'd scroll Twitter and financial news for hours before even looking at charts. Every breaking news alert made her nervous. She'd jump into trades impulsively, driven by fear of missing out. Her results were erratic. She made some good trades, but losses wiped out gains fast. Together, we worked on cutting the noise. She unfollowed 80% of her financial accounts on social media. Set a rule: no social media before noon on trading days. Created a watch list of 5 assets she knew well. Developed a morning routine focused on reviewing charts, not news. Practiced daily mindfulness to manage emotions. Within weeks, Sarah's trading became calmer, more consistent, and surprisingly profitable. She told me, "I never realized how much noise was controlling me. When I killed the noise, I started hearing the market clearly for the first time. Exercises to kill your noise. Noise audit. For 3 days, track every time you check news, social media, or chat rooms related to trading. How many times a day do you consume noise? Reflect on how it affects your emotions and decisions. Create a noise diet. Choose 2 trusted sources to follow. Block or mute others. Limit checking news or social media to 2 fixed times per day. Stick to this for a week and observe how your mental clarity changes. Mindful pause. Before every trade, take 3 deep breaths. Ask yourself, is this trade based on my plan or the noise I just consumed? If it's noise, walk away. What? Killing the noise. Unlocks when you learn to cut through the chaos and focus on the signal. Your mind becomes sharper and less reactive. You trade from confidence, not fear or hype. Your risk management improves because you're not chasing losses. You develop patience to wait for high probability setups. Your trading becomes more enjoyable, less stressful. In essence, killing the noise creates mental space for you to think clearly and execute your plan. Summary: your noise-free trading mindset. The market is noisy. Your job is to focus on what matters. Identify and eliminate noise sources that trigger emotions. Build a structured trading routine that limits distractions. Practice emotional control to avoid reacting impulsively. Think independently and trust your analysis. Simplify your approach to amplify clarity. Use technology wisely, as a tool, not a crutch. Remember, noise is the enemy of success. Silence your inner chaos, and the market's true voice will become clear. Chapter 3. Process over. Profit detach from outcomes. Obsess over execution. The profit obsession trap. If you ask most new traders what they want, their answer usually revolves around money, how much profit they can make, how fast they can grow, their account, and how quickly they can hit a home run trade. This focus on profit is natural. After all, trading is a business, and the goal is to make money. But here's the problem. When you obsess over profits, you start chasing results instead of focusing on the process that produces those results. Imagine an athlete who only cares about the scoreboard, not the daily grind of training, technique, and nutrition. Or a musician who only cares about applause, not the hours of practice. In trading, this obsession with the outcome often leads to impulsive decisions, emotional roller coasters, and inconsistent performance. You become a results junkie, fixated on wins and losses, and every trade feels like a test of your worth. Why process beats profit? Every time. The truth is, you cannot control profits. Profits are the outcome of many variables. Market conditions, volatility, timing, and yes, even luck. What you can control is your process. The plan, the preparation, the discipline, the risk management, and your execution. Successful traders don't judge themselves on how much money they made in a day or a week. Instead, they ask, did I follow my trading plan? Did I manage my risk properly? Did I stick to my rules without hesitation? Did I maintain discipline and emotional control? Did I journal my trades honestly and learn from mistakes? When you focus on process over profit, you build a repeatable, reliable system that will generate profits over time, even if individual trades or days don't always go your way. The psychological benefits of a process-driven mindset. Focusing on the process reduces emotional swings that are triggered by profits or losses. You stop feeling like every trade is a referendum on your skill or self-worth. Instead, you see trading as a craft, a continuous improvement journey where every trade is a step. This mindset builds resilience. You learn to accept losses as part of the process, not a failure. You recognize that some days you will win, Some days you will lose, but consistent application of your process leads to long-term success. The pressure to perform dissipates. Instead of being reactive and fearful, you become proactive and confident. How? To shift your mindset from profit to process. Define your edge clearly. Your edge is the unique advantage or method you use to identify trades. It might be a technical pattern, a strategy based on fundamental data, or a combination. The clearer you are about your edge, the easier it is to measure process execution, independently of profit. Write down your edge in simple terms. For example, buy when the 50-day moving average crosses above the 200-day moving average, with confirmation from RSI below 30. Short sell when a stock gaps down on bad earnings and fails to recover within the first hour. Having clear, objective criteria lets you check if you followed your edge, no matter the outcome. Develop a trading plan. Focused on execution. A trading plan is your blueprint. It includes entry criteria, exit criteria, position sizing and risk limits, timeframes, and markets traded rules for adjusting trades. Make your plan process-centric. Include checkpoints that measure whether you are sticking to your edge. For example, did I only enter trades meeting my setup criteria? Did I place my stop loss immediately? Did I avoid trading during high volatility events? Journal every trade process. Before profit trading, journals are one of the most powerful tools for process improvement. But many traders focus on recording profits and losses. Instead, use your journal to track process adherence. Create a checklist for each trade. Did I follow my entry rules? Was my position size correct? Did I manage my risk as planned? What emotions did I feel before, during, and after the trade? What can I learn from this trade? After a few weeks, review your journal and look for patterns. You might find that the trades where you followed the process produced better overall results, even if some individual trades lost money. Set daily and weekly process goals to reinforce a process mindset. Set goals based on your behavior and execution, not profits. Examples: execute at least 3 trades following my plan this week. Journal every trade before market close today. Avoid impulsive trades for 5 consecutive days. Review and update my trading plan every Sunday. By focusing on these goals, you build habits that lead to success. How to handle losing trades when you focus on process. Losing trades are inevitable, no matter how good your edge is. But with a process mindset, losses become learning opportunities, feedback on your system, a chance to improve discipline. If you lose a trade but followed your process perfectly, you don't beat yourself up. You know that no system wins every time. The long-term expectancy is what matters. If you lose because you deviated from the plan, your journal helps you catch that and recommit to discipline. Avoiding the profit-chasing pitfall. One of the most damaging behaviors in trading is profit chasing, making reckless trades to make back lost money or boost gains. This usually happens when traders fixate on profits and forget process. To avoid this, stick strictly to your plan and risk limits. Take breaks if you feel emotional or desperate. Remind yourself that every trade is just one data point. Your goal is consistency. Remember, you don't have to trade every day. Real trader story. Meet David. From profit chasing to process mastery, David was a trader who started with a huge focus on profits. Every day, he'd obsess over his account balance. When he lost, he doubled down to recover fast. When he won, he got overconfident and risked too much. His account went on a roller coaster, and his stress levels skyrocketed. When I introduced David to the process over profit mindset, he was skeptical at first. We worked on defining his edge clearly and building a strict trading plan. He committed to journaling every trade and reviewing his emotional state. At first, profits didn't jump dramatically, but over 6 months, his consistency improved dramatically. His wins and losses balanced out more evenly. More importantly, his stress vanished. David told me, "I finally stopped feeling like a gambler. I'm a trader with a plan and control. Tools to support your process." Mindset, here are some practical tools to reinforce process-driven trading. Trading checklists. Create pre-trade and post-trade checklists to ensure discipline. Journaling apps. Use apps like Edgewonk or TraderSync to track detailed trade data and emotions. Timers and alarms. Set reminders to take breaks and avoid overtrading. Accountability partners. Share your plan and results with a mentor or group to stay honest. Process over. Profit. Key takeaways. Profit is an outcome. Process is the cause. Control what you can, your process. Define your edge clearly so you can measure process adherence. Build a trading plan focused on execution and risk management. Journal every trade with an emphasis on process, not just P&L. Set behavior goals to build consistent habits. Embrace losing trades as part of your growth, not failure. Avoid profit chasing by sticking to your rules and taking breaks. Use tools and community for accountability and support. Chapter 4. Emotional Control. Edgemaster. Fear, greed, FOMO, revenge. Why emotional control is the greatest trading edge. If you asked professional traders what their greatest edge is, many wouldn't cite fancy algorithms, complex technical indicators, or insider tips. They'd say, emotional control. No matter how perfect your strategy or analysis is, if your emotions dictate your trades, you will fail. The markets are designed to trigger emotional responses: fear, greed, excitement, panic, regret. This emotional volatility is as real and as dangerous as market volatility. Trading is one of the few professions where your mind can directly sabotage your results. The ability to control your emotions, to stay calm, rational, and disciplined, is often the single biggest factor separating consistent winners from losing traders. The 4 emotional patterns that destroy traders. Let's unpack the 4 most common destructive emotions that sabotage traders. Fear is the primal, survival instinct kicking in when your money is at risk. In trading, fear often manifests as hesitation to enter good trades because you're afraid of losing. Exiting profitable trades too early out of worry. Avoiding trades entirely and missing opportunities, freezing or panic selling during drawdowns. Fear triggers your fight-or-flight response, which works great for life-or-death situations, but ruins decision-making in trading. When fear takes over, traders lose clarity and act impulsively or freeze, neither of which helps their bottom line. Greed is the desire to maximize gains at all costs. It shows up as overtrading to chase more profits, ignoring risk management in pursuit of big wins, holding on to winning trades for too long, hoping for more, increasing position size beyond your comfort zone. Impulsively, greed blinds you to risk and makes you forget your plan. It can lead to catastrophic losses when the market reverses unexpectedly. FOMO, fear of missing out. FOMO is the anxiety that you're missing a great opportunity others are capitalizing on. It causes jumping into trades late with poor risk-reward. Setups. Over-leveraging to catch the next big move. Ignoring your strategy and chasing hype or rumors. Feeling pressure to constantly be in the market without proper analysis. FOMO-driven trading is reactive, emotional, and almost always costly. Revenge trading. Revenge trading is the attempt to recover losses quickly by making aggressive trades, often without logic. It manifests as trying to win back lost money immediately after a loss, increasing trade size impulsively, ignoring your trading plan and risk limits, experiencing escalating losses due to emotional decision-making. Revenge trading is a destructive cycle that can wipe out accounts fast. How these emotions impact your trading. Psychology. Each of these emotional patterns leads to inconsistent decision-making. Emotional trades rarely follow a plan. You become reactive rather than strategic. Poor risk management. Fear, greed, and revenge make you ignore stops or take outsized risks. Impaired judgment. Your brain focuses on immediate emotional relief rather than long-term results. Loss of confidence. The cycle of emotional mistakes erodes self-trust and increases anxiety. Burnout. Emotional stress leads to fatigue, affecting focus and performance. The market isn't your enemy. Your uncontrolled emotions are. Emotional self-awareness. The first step to mastery. Before you can control your emotions, you must become aware of them in real time. This means learning to recognize the physical signs of emotions: racing heart, sweating, tightness, shallow breathing. Identify the mental patterns: racing thoughts, what-if scenarios, catastrophic thinking. Observe your impulses without judgment. One powerful technique is mindfulness. The practice of observing your thoughts and feelings without immediately reacting. During trading, pause and ask, what emotion am I feeling right now? Fear? Greed? FOMO? What thoughts are fueling this emotion? How might this emotion affect my decision? Am I about to deviate from my plan because of this? This self-check allows you to regain control before acting on emotion. Strategies to regulate your emotions. Effectively, awareness is only the first step. The next is emotional regulation. Consciously managing your feelings so they don't impair your judgment. Here are proven strategies. Develop a pre-trade routine. A structured routine before every trade builds mental readiness and calms nerves. Examples include deep breathing exercises to reduce anxiety, reviewing your trading plan and checklist, visualizing a calm, successful trade, execution, setting clear entry, stop loss, and exit levels. This preparation anchors your mind and reduces emotional impulsivity. Use breathing techniques to stay calm. When you feel fear or panic rising, your body goes into fight or flight mode. Deep, slow breathing activates the parasympathetic nervous system, the rest and digest mode, calming your nervous system. Try this. Inhale slowly through your nose for 4 seconds. Hold for 4 seconds. Exhale slowly through your mouth for 6 seconds. Repeat 3 to 5 times before making decisions. This simple practice improves clarity and emotional control. Detach emotionally from money. A powerful mental shift is to stop seeing each trade as your money. Instead, treat trading like a business experiment. If you think in terms of probability, statistics, and repeatable processes, losses become data points, not personal failures. Set a fixed risk per trade, e.g., 1% of your account, so losses don't feel catastrophic. This detachment reduces fear and emotional reactivity. Limit screen time and overtrading. Watching the markets obsessively fuels emotional volatility. Set specific trading windows and stick to them. Overtrading often stems from boredom or FOMO and leads to emotional exhaustion. Taking breaks helps maintain a fresh, calm mindset. Use journaling to track Emotional patterns include an emotional section in your trading journal. What emotions did you feel before, during, and after the trade? Did those emotions affect your decisions? How? What triggers set off emotional reactions? Over time, you'll identify patterns, such as trading more aggressively after losses or feeling FOMO during certain news events. Journaling helps you preempt emotional pitfalls. Recovery techniques, how to bounce back from emotional blows. Trading will inevitably bring tough days and losses. How you recover emotionally is critical. Accept losses as part of the game. Accept that losses are normal and expected. Reframe losses as feedback to improve your system. An investment in learning, a necessary step to long-term success. Acceptance reduces frustration and guilt. Take a break. When needed, after emotional losses or a streak of bad trades, step away. Do something non-trading related. Walk, exercise, meditate, or connect with loved ones. Breaks help reset your emotional state and improve perspective. Practice self-compassion. Traders often beat themselves up for mistakes. Practice self-compassion. Treat yourself as kindly as you would a friend who's struggling. Say, I did my best with what I knew. Mistakes are part of growth. I am learning and improving every day. Self-compassion boosts confidence and reduces emotional burnout. Visualize success and emotional stability. Daily visualization exercises can program your brain for doing emotional resilience. Imagine yourself trading calmly, sticking to your plan, and handling losses gracefully. Repetition strengthens neural pathways and builds emotional control. Practical exercises to build emotional mastery. Here are some actionable exercises. Pre-trade mindfulness. Before trading, sit quietly for 2 minutes and scan your body for tension. Breathe deeply and release it. Emotion labeling. During trading, pause and label your emotion out loud. This is fear, or this is greed. Naming emotions reduces their power. Post-trade reflection. Write a paragraph about how you felt and acted. What worked? What didn't? Stress management routine. Develop daily habits like meditation, journaling, or light exercise to reduce baseline anxiety. The neuroscience behind emotional control. In trading, understanding how your brain reacts can help you take control. The amygdala is the emotional center that triggers fear and fight or flight. It reacts faster than your conscious brain. The prefrontal cortex governs logic and decision-making, but is slower to respond. When stressed, your amygdala can hijack your prefrontal cortex, leading to impulsive trades. Training your mind through mindfulness and emotional regulation strengthens the prefrontal cortex's control, helping you make calm, rational decisions. Final thoughts. Emotional control is your ultimate edge. Technical analysis, strategy, and capital are all important, but none of those matter if you cannot control your emotions. Mastering emotional control is a lifelong journey. It requires practice, patience, and honesty. But the payoff is immense. You trade confidently under pressure. You stick to your plan without wavering. You recover quickly from losses. You build consistent profits over time. You enjoy the process and reduce stress. Emotional mastery is the true competitive advantage in trading. Chapter 5. Patience pays. Sit on your hands. Wait for high-conviction setups. The paradox of patience in trading in a world obsessed with speed, instant results, and constant action. Patience feels counterintuitive, especially in trading, where market prices move every second and news flows nonstop. It seems like more action equals more opportunity. But here's the paradox. In trading, sometimes the best move is to do nothing at all. Patience is not passive waiting. It's a powerful, active skill. The ability to wait deliberately for the right moment, rather than reacting to every impulse. The traders who succeed long-term aren't the ones who chase every price tick or jump on every trade idea. They are the ones who develop the discipline to wait, to only trade when the setup has high conviction and a favorable risk-cash reward. Why patience is your most profitable skill. The market will always offer opportunities. The challenge is distinguishing high-quality setups from noise and temptation. Rushing to trade without patience leads to entering low-probability trades that are more likely to lose, overtrading, which increases transaction costs and emotional fatigue, poor risk management as impatience pushes you to accept bad risk-reward ratios, emotional stress from constantly monitoring and reacting to the market. On the other hand, patience allows you to wait for high-conviction setups that statistically have a better chance of success, avoid unnecessary losses and reduce the number of losing trades, improve your win rate and overall profitability. Trade with calm confidence, knowing you are acting on quality signals, the true meaning of doing nothing. Doing nothing in trading isn't about passivity or inaction born from fear. It's a disciplined choice. Consider this. A trader who constantly trades is like a gambler rolling dice every minute hoping for a win. A patient trader is like a sniper, waiting for the perfect target to appear before pulling the trigger. Doing nothing is often the most profitable decision because many trading setups never meet your criteria. Trying to force a trade where there's no edge leads to small, frequent losses that add up. Sitting on your hands means controlling the urge to act impulsively. It means waiting for the market to come to you rather than chasing it. Delayed gratification. The mindset behind patience. Patience in trading is a form of delayed gratification. The ability to resist the urge for immediate rewards in favor of larger, more reliable payoffs later. This mindset requires trusting your analysis and strategy enough to wait for confirmation, means accepting the discomfort of missing out sometimes, because missing a bad trade is a win, helps you avoid emotional trading driven by FOMO, fear of missing out, or boredom. Studies in psychology show that people who master delayed gratification tend to be more successful in many areas of life. The same principle applies in trading. How to cultivate patience. Practical steps. Patience is a muscle you can build and strengthen over time. Here are key strategies. Define clear entry criteria. Develop a precise checklist or rules for entering trades. Your criteria might include specific technical signals, e.g., price action patterns, indicator confirmations, fundamental triggers, e.g., earnings reports, economic data, risk, reward, ratio thresholds, e.g., minimum 1.2, reward to risk, volume or market context requirements. When you have clear rules, you don't have to guess. If the market doesn't meet your criteria, you don't trade. Use limit orders instead of market orders. By placing limit orders, you set your entry price and refuse to buy or sell at worse prices. This forces you to wait for the market to come to your price and prevents chasing moves impulsively. It's a simple mechanical way to inject patience into your trading. Keep a trading journal, focusing on patience record instances when you waited and didn't trade because the setup wasn't good. Note the outcome. Also, write down impulsive trades driven by impatience and their results. Review your journal regularly to reinforce the value of waiting. Set time limits for decision-making. Sometimes, patience is hard because the market seems to be moving away. Set a time limit to evaluate trades. For example, I will watch this setup for 1 hour, and if it doesn't meet criteria, I'll step away. This prevents overanalyzing while still maintaining discipline. Practice meditation and mindfulness developing. Patience outside the market transfers to better trading habits. Meditation helps you observe urges and impulses without immediately acting. Over time, this builds your ability to sit with discomfort and delay action. Case study: patience pays off. In real trading, imagine two traders watching a breakout setup on a stock. Trader A impulsively buys as soon as the price moves above resistance without confirmation. The breakout fails and the stock quickly falls, causing a loss. Trader B waits patiently for volume confirmation and a retest of the breakout level. Only after these conditions are met does Trader B enter. The stock continues higher, and Trader B locks in a profit. Trader B's patience turned a risky, impulsive move into a calculated, higher probability trade. The cost of impatience. Impatience is a silent killer in trading. Its costs are eroding your capital through repeated small losses, increasing stress and emotional turmoil, breaking your trading plan and damaging confidence, encouraging revenge, trading to make up for losses quickly, shortening your trading career due to burnout and frustration. Understanding these costs should motivate you to slow down and wait. The science behind patience in decisions. Making neuroscience research shows that patience involves balancing two brain systems: the impulsive system, limbic system, that seeks immediate reward; the deliberative system, prefrontal cortex, that plans for the future. Successful traders strengthen their prefrontal cortex control through practice, allowing them to override impulsive urges. Practicing patience is literally training your brain for better decision-making. Practical tools to strengthen patience. Visual reminders. Place a sticky note near your trading screen with a simple mantra. Wait for the perfect setup. Patience wins. Sit on your hands. This reminder can halt impulsive actions. Breathing exercises. When you feel an urge to trade impulsively, pause and take 3 deep breaths to regain composure. Accountability, partner, or mentor. Discuss your trades and decisions with a mentor who values patience. Having someone to hold you accountable helps reduce impulsive mistakes. How patience connects to other trading skills. Patience is the foundation for emotional control. Waiting calmly reduces emotional reactivity. Risk management. Only risking capital when setups meet criteria. Discipline. Following your plan consistently. Confidence. Knowing you are acting on quality trades builds trust in yourself. Patience enhances every part of your trading process. The reward. More profit, less stress. Patience doesn't just improve your trading results, it improves your quality of life. You'll feel less anxiety watching markets, more confidence in your decisions, greater satisfaction with your process, better sleep knowing you're not chasing losses. Final thoughts. Sit on your hands. Let profits come to you. Mastering patience is one of the hardest skills in trading, but the payoff is enormous. Remember, the market always offers opportunities. You don't have to take them all. Waiting for high-conviction setups separates winners from gamblers. Delayed gratification leads to bigger, more consistent profits. Patience is an active choice. It's not about doing nothing, but doing the right thing at the right time. When in doubt, sit on your hands and wait. Chapter 6. Small loss, big win. Master risk. Protect your capital to unlock consistent profits. The unsexy truth about trading. Risk management is survival. When you first start learning about trading, it's easy to get mesmerized by the sexy parts. Big winning streaks, explosive gains, chart patterns, and indicators promising to predict market moves. But here's the brutal reality. If you don't manage risk, all those winning trades won't matter. No matter how good your analysis, is or how right your trades seem. One careless mistake or one huge loss can wipe out months or years of hard work. The path to becoming a consistently profitable trader isn't about hitting every trade right. It's about surviving the losing trades with minimal damage. Risk management isn't glamorous, but it is the foundation of survival and eventual success. Why? Small loss, big win is not just a saying. It's a mindset. One of the most important mindsets you must internalize is lose small, win big. It means accepting that losses are part of the game. The goal isn't to never lose, but to manage losses so they are small and controlled, while positioning yourself to let your winners run and grow into big profits. Think of trading like running a business. Small losses, your operating costs, big wins, your profitable deals. If you can keep your operating costs low, the profitable deals will compound your success over time. Position sizing, how much should you risk per trade? One of the most common mistakes beginners make is risking too much on a single trade. It's tempting to go big after a loss or in hopes of a quick windfall, but this often leads to devastating drawdowns. Position sizing is the key to controlling risk. It means deciding how many shares, contracts, or lots to buy or sell based on your risk tolerance. Your goal is to risk only a small percentage of your total trading capital on any single trade. Most professional traders recommend risking no more than 1 or 2% of your total capital per trade. For example, if you have a $10,000 trading account, risking 2% means you are risking $200 max per trade. If your stop loss is $2 below your entry, your position size should be 100 shares, because 100 shares x $2 loss, 200. This simple calculation limits how much damage any one trade can do. It's your safety net. Stop losses. Your best friend, not your enemy. If position sizing is how much risk you take, stop losses are how you control it. Stop losses are predefined exit points that close your trade automatically if the market moves against you beyond a certain point. Many traders fear stop losses because they worry about getting stopped out prematurely. They feel it limits their potential profit. But stop losses are not your enemy. They are your best protection. Without a stop loss, you risk letting a small loss turn into a catastrophic loss. Emotion often takes over, and traders hold losing positions hoping the market will reverse, only to watch losses pile up. How to place effective stop losses. There's an art to placing stop losses that balances protecting your capital and avoiding being stopped out on normal market noise. Here are a few guidelines. Place stops just beyond technical support or resistance levels. For example, below a recent swing low if you're going long. Avoid placing stops too tight where normal volatility will trigger them. Use average true range, ATR, or volatility measures to gauge how much the price normally moves and set stops accordingly. Adjust stop size based on your risk tolerance and the specific trade setup. The psychology of accepting losses. Accepting losses isn't easy. Psychologically, it triggers feelings of failure, regret, or frustration. However, every trader loses. The difference is how you handle it. To build a healthy relationship with losses. Understand losses are inevitable and part of the learning curve. They don't define your ability. View losses as data and feedback. Each loss teaches you something about the market, your strategy, or your mindset. Use losses to refine your process, not punish yourself emotionally. The power of cutting losses. Quickly. One hallmark of successful traders is the discipline to cut losses quickly. Letting losses run is one of the fastest ways to blow your account. Studies show that traders who cut losses early tend to perform better than those who try to hold on and wait for a rebound. Remember, the goal is to preserve capital for the next opportunity. Riding winners. Let your profits run. Just as important as cutting losses is letting your winners run. Many traders fall into the trap of taking profits too early out of fear. This limits their upside. To let winners grow, use trailing stops to lock in profits while allowing the trade to continue if the market moves favorably. Identify key resistance or support levels where you might exit partially or fully. Have a profit target, but remain flexible if the market momentum remains strong. The risk-reward ratio. The heart of smart trading. Every trade should be evaluated based on its risk-reward ratio. How much you risk versus how much you expect to gain. Good rule of thumb is a minimum 1.2 risk-reward ratio, meaning your potential profit should be at least twice the amount you risk. Why does this matter? Because even if you win less than half your trades, you can still be profitable if your winners are bigger than your losers. The importance of consistency in risk management. Successful trading is not about a few lucky wins. It's about consistent application of risk management principles. That means always using position sizing rules, always placing stop losses, always calculating risks, reward before entering a trade, avoiding impulsive trades that don't meet your criteria. Consistency is what turns risk management from a theory into a habit that protects your account. Examples of risk management gone wrong. To understand why this matters, let's look at a few cautionary tales. Example 1. The 10% risk trap. A trader risks 10% of his account on each trade. A string of just 4 losses wipes out more than half the account. Recovering from that drawdown requires an outsized winning streak. A brutal uphill battle. Example 2. No stop loss. Madness. Another trader refuses to place stop losses, believing the market will always come back. One big unexpected move triggers a catastrophic loss that destroys his account. These examples highlight the dangers of neglecting risk controls. Advanced risk techniques, scaling in and out. Once you master basic risk management, you can refine it further by scaling in, entering a position gradually as the trade confirms strength. This reduces initial risk and allows you to add size safely. Scaling out, taking partial profits at predefined targets, locking in gains while leaving some exposure for larger moves. These techniques add flexibility and precision to your risks. Control, emotional control through risk management, strong risk controls. Reduce emotional stress by limiting financial damage and protecting your capital, giving you clear rules to follow. Removing guesswork, building confidence in your trading process. When you know your maximum loss up front, you can trade calmly and objectively. The long game, risk management and trading. Longevity traders who master risk management stay in the game longer. And longer participation statistically leads to better results. It's the difference between burning out after a few large losses, building steady equity growth over months and years. Think of your trading capital as a garden. Risk management helps you water it carefully and avoid destroying the plants in one storm. Common risk management. Mistakes to avoid. Over-leveraging. Using too much borrowed money magnifies losses. Ignoring stop losses. Letting emotions overrule discipline. Revenge trading. Trying to immediately make back losses leads to reckless decisions. Chasing trades. Entering trades outside your plan. Trading with large position sizes during high volatility. Amplifies risk unexpectedly. Avoiding these traps is key to long-term success. Practical risk management checklist. Before every trade, Ask yourself, how much am I risking on this trade? Does this risk fit within my overall risk tolerance? Where is my stop loss? And why? What is my profit target? Is the risk-buck-reward ratio favorable? Am I emotionally calm and not chasing? Do I have a plan for scaling in, out if needed? If you can answer these honestly, you're practicing good risk discipline. Building your loss budget. Consider your trading capital as a loss budget. If you risk 2% per trade, you can lose 25 trades in a row before wiping out your capital. This buffer allows you to take your time, learn, and improve without catastrophic consequences. This perspective helps reduce the fear of losses, which, paradoxically, improves your decision-making. Summary: the path to survival and profit. To wrap up, risk management is the single most important skill in trading. Always risk a small, defined percentage of your capital per trade. Use stop losses consistently to protect yourself from big losses. Accept losses quickly and cut them short. Let your winners run and aim for a favorable risk-reward ratio. Avoid emotional mistakes like revenge trading and over-leveraging. Be consistent and disciplined. This is your best edge. By embracing the small loss, big win mindset, you build a resilient trading approach that stands the test of time and market volatility. Chapter 7. You versus you. The market isn't your enemy. You are. When traders lose money, their immediate instinct is often to blame the market, the economy, or even bad luck. The truth is much more personal and far more powerful. The biggest battle you will ever fight as a trader isn't against the market. It's against yourself. The internal battlefield. Understanding the real enemy. The external chaos of price charts, economic news, and market volatility can be overwhelming. But these are just the surface-level challenges. The core, persistent struggle happens inside your own mind. Your thoughts, emotions, beliefs, and biases are constantly shaping your decisions, sometimes helping, but often sabotaging your trading success. Ego. The silent saboteur. Your ego is your sense of self, your identity, pride, and the story you tell yourself about who you are. In trading, the ego can quickly become your worst enemy. Overconfidence. After a few wins, you start believing you are infallible. This illusion leads to larger position sizes, ignoring risk controls, and chasing trades without proper analysis. Fear of losing face. The ego hates admitting mistakes. This often results in holding on to losing trades for too long, trying to prove, "I was right," instead of cutting losses early. The need to be right. When your ego is involved, trading turns from a neutral activity into a personal battle. Every loss feels like a personal failure, and every gain an ego boost. This mindset clouds objectivity and rational decision-making. Overconfidence. The hidden risk, overconfidence, isn't just arrogance. It's a cognitive bias where you overestimate your abilities or underestimate risks. In trading, overconfidence manifests as taking more risk than usual after a winning streak. Ignoring warning signs or market signals, neglecting your own rules and trading plans. Believing you can beat the market, no matter what. Overconfidence often leads to big losses because it blinds you to reality. Remember, the market doesn't care about your ego or your pride. It reacts to price action alone. The paralysis of self-doubt. On the other side of the spectrum, self-doubt can be just as crippling. Self-doubt causes hesitation in executing trades, leading to missed opportunities, constant second-guessing, which wastes mental energy, avoiding taking responsibility for decisions, blaming outside factors, anxiety and fear that paralyze your ability to act decisively, while a healthy, level of caution is necessary in trading. Excessive self-doubt causes analysis paralysis, eh? Where you overanalyze every detail and end up doing nothing. The vicious cycle, ego and self-doubt, feeding each other, it might seem these two, ego and self-doubt, are opposites, but they often feed into one another in a toxic cycle. After a big win, your ego inflates and you trade recklessly. After a big loss, self-doubt takes over, shaking your confidence and making you hesitate. Then your ego tries to overcompensate for the loss with bigger, riskier trades. The cycle repeats, with swings between reckless bravado and paralyzing fear. Breaking this cycle is crucial to becoming a consistent trader. Self-sabotage. How you become your own worst enemy. Self-sabotage is the unconscious behavior that prevents you from achieving your trading goals. Common self-sabotaging behaviors include chasing losses, trying to win it all back immediately after losing, leading to riskier trades, ignoring your plan, deviating from your strategy out of impatience or boredom, emotional trading, letting anger, frustration, or excitement drive your decisions instead of logic, confirmation, bias, only seeing information that supports your current view, ignoring contrary evidence, blaming external factors, never owning your mistakes or learning from them. If you don't identify and address these patterns, they will keep pulling you back, no matter how much you learn about charts or indicators. The role of mindfulness in trading. To fight the internal battles, traders must develop a self-awareness, the ability to observe your thoughts and emotions without judgment. Mindfulness practices help you catch negative thought patterns early, stay calm during market volatility, respond deliberately rather than react impulsively, increase emotional resilience over time. Simple mindfulness techniques like focused breathing, journaling, or short meditation. Breaks during trading sessions can create a buffer between stimulus and response, giving you greater control over your decisions. Building emotional resilience. Emotional resilience is the capacity to withstand stress and bounce back from setbacks without losing your mental equilibrium. Key ways to build resilience include reframing, loss as feedback, not failure. Every losing trade is a lesson that refines your approach. Developing patience, accepting that consistent profits come over time, not overnight. Setting realistic expectations. The market won't always go your way, and that's normal. Having a strong why, knowing your deeper reason for trading, helps you stay focused beyond short-term ups and downs. The power of journaling, your trading mirror. One of the most effective tools to combat internal conflict is keeping a trading journal. A good trading journal records your trade setups and the rationale behind entering and exiting, the emotions you felt before, during, and after trades, lessons learned from each trade, mistakes made, and how you'll correct them. Regular. Journaling shines a light on recurring patterns of self-sabotage and emotional pitfalls. It forces you to confront your internal dialogue and develop strategies to change destructive habits. Cultivating humility. The trader's superpower. Humility means recognizing that no one, no matter how skilled, can predict or control the market perfectly. Traders with humility are open to learning and adapting. Don't let ego cloud their judgment. Accept losses gracefully and move forward. Seek feedback and mentorship. Humility frees you from the trap of being right and instead focuses you on being profitable. Confidence versus arrogance. Walking the fine line. True confidence in trading comes from mastery of your skills and strategy, consistent application of your trading plan, knowing your risk limits and respecting them, being mentally prepared for losses and wins alike. Confidence is calm, steady, and grounded in reality. Arrogance, by contrast, is inflated ego dressed as confidence, leading to reckless behavior and poor risk management. Developing a growth mindset, a fixed mindset, sees talent and intelligence as static. A growth mindset believes you can improve through effort and learning. Traders with a growth mindset view setbacks as opportunities to grow. Embrace challenges rather than avoid them. Persist in the face of obstacles, continuously refine their process. This mindset is a crucial internal tool for overcoming self-doubt and ego traps. Techniques to win the you versus you battle. Pre-trade routine. Develop a ritual before trading to center your mind. Review your plan, calm your emotions, and set clear goals. Emotional check-ins. Periodically assess your mental state during trading sessions. If anxiety, frustration, or overexcitement creeps in, pause and reset. Visualization. Imagine handling losses calmly and sticking to your plan even under pressure. Mental rehearsal prepares you for real situations. Accountability. Partner. Share your trading goals and challenges with someone you trust. External accountability helps counter ego-driven justifications. Regular breaks. Avoid burnout and emotional fatigue by stepping away from screens and markets regularly. Recognizing when to step back. Sometimes, the best move is to pause trading altogether. After a series of losses, when emotions are raw, when you're feeling overconfident and reckless, when life stress spills over and clouds judgment, when you're chasing revenge, trades, taking a break isn't quitting. It's resetting and protecting your capital and mental health. The role of therapy and coaching for some traders, especially those struggling deeply with self-sabotage or anxiety. Professional help like cognitive behavioral therapy, CBT, or coaching can be transformative. These approaches help you understand and reframe destructive beliefs, build coping, strategies for stress, improve decision-making skills under pressure. If trading emotions consistently derail you, consider reaching out to experts. Real traders' stories, you versus you. Many successful traders openly share that their biggest struggles were internal. For example, Paul Tudor Jones admits fear and self-doubt haunted him early in his career, but overcoming those made him a legendary trader. Mark Douglas, author of Trading in the Zone, emphasized that mastering your mindset is more important than mastering technical analysis. These stories remind us all that internal battles are universal and winnable. Chapter 8. Detach from the chart. Your identity is not your P&L. One of the hardest lessons every trader must learn is this simple but profound truth. Your value as a person is not tied to your trading profits or losses. Your trading account balance, your daily profit and loss, P&L, the number on your screen after every trade, none of these define you. Yet many traders fall into the trap of merging their identity with their trading results, creating a dangerous emotional dependency on outcomes that are inherently uncertain and often uncontrollable. Why detachment matters at first glance? It might seem counterintuitive to detach from something as important as your money or trading success. After all, trading is how you make money, and you want to be fully engaged, right? Yes, you need focus and commitment, but the problem arises when emotional attachment takes over. When every tick on the chart feels like a personal judgment of your worth or intelligence, your decisions become clouded with anxiety, fear, or greed. Emotional attachment to your trades fuels impulsive reactions like revenge trading, overtrading, or freezing up during critical moments. Detachment, on the other hand, empowers you to view losses as data, not disasters. Execute your plan consistently regardless of recent outcomes. Maintain mental clarity in volatile markets. Recover faster from setbacks and avoid burnout. Trading is a game of probabilities. The market will win some, and you will win some. Your mindset must be strong enough to embrace that uncertainty without collapsing emotionally. The roots of emotional attachment in trading. To detach effectively, first understand why emotional attachment happens. Money and identity are deeply linked. For many, money is a symbol of success, security, and self-worth. Losing money feels like losing status or validation. High stakes. Trigger survival mode. The fear of losing capital activates primal brain, centers designed to protect us. This fight-or-flight response floods you with stress hormones that impair rational thinking. Psychological biases. Humans are wired to avoid loss more than they value gains. Loss aversion. This leads to clutching onto losing trades or chasing risky moves to get back what was lost. Social pressure and ego. Traders often feel pressure to prove themselves, to family, friends, or themselves. The desire to look competent can make it impossible to accept losses gracefully. Unrealistic expectations. New traders often expect quick profits, and any deviation from that ideal can feel like personal failure. How emotional attachment undermines trading. Emotional attachment impacts your trading in many subtle and destructive ways. Impulsive decision-making. Fear or greed pushes you to act without analysis, ignoring your plan or risk controls. Poor risk management. You risk too much to win back losses or hold on to losing trades too long. Analysis paralysis. Sometimes fear of loss causes hesitation, making you miss good trades or exit winners prematurely. Burnout. The constant emotional roller coaster drains your mental energy and motivation. Tunnel vision. Being emotionally hooked on a trade blinds you to new information or changing market conditions. Ultimately, emotional attachment limits your ability to trade with discipline and consistency. The core traits of successful traders. Practical steps to detach from. The chart detachment doesn't mean you become cold or indifferent. It means you develop a healthy emotional boundary that allows you to trade with clarity and resilience. Here are powerful ways to build that boundary. Redefine your identity. Beyond trading, your self-worth is multidimensional and cannot be measured by a fluctuating number on a screen. Cultivate a strong sense of identity based on your values, relationships, skills, and passions outside trading. Take time daily to remind yourself who you are beyond the trader's chair. This might mean journaling about your strengths, spending quality time with loved ones, or pursuing hobbies that bring fulfillment. Embrace the concept of trading as a business, not a game view trading as a professional business activity rather than gambling or entertainment. Just like any business, you accept the possibility of losses as part of the process. You focus on process over results. You analyze performance with data and metrics, not emotions. By framing trading this way, you separate your emotions from results and focus on continuous improvement. Develop a trading plan and follow it religiously. The best way to avoid emotional overreactions is to have a clearly defined trading plan with entry and exit criteria, risk management rules, profit targets, and stop losses. Once you commit to your plan, trading becomes about executing the plan rather than winning or losing individual trades. This shift helps prevent impulsive decisions driven by emotion. Practice. Mindfulness and emotional awareness. Mindfulness is a powerful tool to observe your emotions without becoming controlled by them. Simple practices include pausing before making a trade to notice your emotional state, practicing deep breathing during stressful moments, taking short breaks away from the screen to reset your mind. Building emotional awareness allows you to recognize when attachment or fear is creeping in and take steps to regain composure. Use journaling as your emotional detoxer. Trading journal is not just for tracking trades, it's also your outlet for processing emotions. Write down how you felt before, during, and after each trade. What thoughts dominated your mind? Whether fear, greed, or hope influenced your decisions. Reviewing your journal regularly highlights emotional patterns and helps you build strategies to stay detached. Limit screen time and set boundaries. Spending endless hours staring at charts can heighten emotional involvement. Set specific trading windows and take deliberate breaks to maintain mental balance. Physical movement, exercise, or even stepping outside can provide mental clarity and reduce attachment to every price move. Create stop-loss rules for Forex. Emotional health, just like you use stop-loss orders to limit financial risk, have rules to protect your emotional well-being. If you hit a certain loss in a day or week, stop trading. If you feel overwhelmed or emotionally triggered, pause your sessions. Avoid trading when fatigued, stressed, or distracted by outside factors. These boundaries keep your mind sharp and prevent emotional exhaustion. The power of detachment in action. Real-life examples. Consider the story of a trader who faced a devastating loss early in their career, nearly wiping out their account. Instead of spiraling into panic, they took a month off, reflecting on what went wrong and focusing on emotional recovery. When they returned, they re-entered the market with a refined plan and a detached mindset. This mental reset enabled consistent, steady profits over the next years. Contrast this with a trader who lets every loss eat away at their confidence, leading to desperate attempts to make it back with reckless trades. This emotional attachment leads to repeated cycles of losses and frustration. The difference is mindset. Detachment creates space to analyze, learn, and grow, while attachment breeds reactivity and decline. Detachment is not indifference. A common misconception is that detaching means not caring about your trades or outcomes. Nothing could be further from the truth. Detachment means caring deeply about your process, discipline, and growth without letting the outcome dictate your emotions or self-worth. This nuanced emotional state is what separates professional traders from amateurs. You remain fully engaged and committed, but emotionally balanced. Dealing with the fear of missing out. FOMO. Detachment also helps you resist one of the most common emotional traps. FOMO. When you're emotionally attached, seeing a big move you missed can trigger anxiety and impulsive trades to catch up. This usually ends badly. By practicing detachment, you accept that missing trades is normal and that there will always be new opportunities. You focus on executing your plan rather than chasing the market. Resetting after a loss. How to come back. Stronger no matter how skilled you are. Losses will happen. What matters is your ability to recover emotionally and mentally. Here's a practical reset routine. Stop trading immediately. Give yourself space to breathe. Reflect objectively. Review the trade without judgment. What went right? What went wrong? Engage in self-care. Exercise, meditate, or do activities that help you relax. Review your trading plan. Adjust if necessary, but don't abandon it impulsively. Set a return date. Decide when you will start trading again with a clear mind. Resetting this way turns losses from emotional wounds into valuable learning experiences. Cultivating patience. Through detachment, patience is one of the greatest virtues. In trading, detachment supports patience by reducing anxiety over every price fluctuation, helping you wait for high-probability setups instead of forcing trades, encouraging long-term thinking beyond daily wins or losses. Remember, consistency over months and years beats short-term excitement every time. The role of community and support systems. Trading can feel lonely, intensifying emotional attachment to results. Engaging with a supportive trading community or mentor provides perspective and emotional support. Sharing experiences normalizes the ups and downs and reduces the tendency to internalize every trade as a personal success or failure. Chapter 9. Build a bulletproof routine. Discipline is your daily edge. Trading is often portrayed as a high-adrenaline game of intuition and quick reflexes. But behind every successful trader lies something much less glamorous, yet far more powerful. A bulletproof routine built on unwavering discipline. Discipline isn't just about sticking to rules. It's the foundation for mental resilience, emotional control, and consistent decision-making in a market that never sleeps and never plays fair. This chapter will guide you through building your own bulletproof daily routine, one that prepares your mind and body to handle the stresses of trading, keeps you aligned with your goals, and turns your mindset into a competitive advantage. Why routine matters more than talent or strategy. Before we dive into the how, it's important to understand why routine matters. Markets are unpredictable. Even the best strategies hit losing streaks. Without discipline and routine, even the most talented traders falter because emotional impulses take over when things get tough. Routine creates consistency. When markets are chaotic, a routine brings predictability to your day, reduces decision fatigue. When your morning, preparation, and review processes are automated, your brain saves energy for critical trading decisions, builds mental resilience. Regular habits strengthen your psychological muscles, helping you bounce back from losses, fosters growth. A routine with journaling and review encourages learning and continuous improvement, balances mind and body. Physical health habits improve focus and stress management. In short, your routine becomes the backbone supporting your trading performance. The framework of a bulletproof trading routine. Your routine should encompass 4 key pillars: morning, preparation, trading session, execution and review, physical health and energy management mindset, journaling and reflection. Let's explore each pillar in detail. Morning preparation. Set the tone for success. The way you start your day sets the emotional and cognitive tone for your trading session. Top traders wake up not rushing into charts, but following a thoughtful process that centers their mind and sharpens focus. Morning preparation should include: wake up at a consistent time. Train your body clock by waking up at the same time every day, even on weekends. Consistency boosts mental alertness. Hydrate. Your brain functions better when well hydrated. Drink a glass of water first thing. Mindfulness or meditation. Spend 5 to 10 minutes practicing mindfulness or meditation to clear your mind of distractions and anxieties. Even simple breathing exercises can lower cortisol, stress hormone, and improve concentration. Physical movement. Light exercise, stretching, or yoga wakes up your body and improves blood flow to the brain. Nutrition. Eat a balanced breakfast with protein, healthy fats, and complex carbs to fuel your brain. Avoid heavy sugar or caffeine spikes that lead to crashes. Pre-market research. Spend 15 to 30 minutes reviewing overnight news, economic calendar events, and market sentiment. Focus on what matters to your strategy. Don't get overwhelmed by noise. Set clear intentions. Write down your top 3 trading goals for the day. These should focus on process, e.g., follow my trade plan exactly, limit risk to 1% per trade, rather than outcomes, make 500. Trading session, execution and review. Discipline and action, the core of your routine, happens during and immediately after your trading sessions. Execution requires follow your trading plan. Every trade should be entered and exited according to your predefined rules. No exceptions. Manage risk vigilantly. Use stop losses and position sizing. To protect your capital, stay emotionally aware. Check in with yourself regularly. Are fear, greed, or impatience creeping in? If yes, pause and reset. Avoid overtrading. Stick to your plan's trade frequency limits. More trades don't equal more profits. Take scheduled breaks. Eyes off the screen. Stretch, hydrate. Mental breaks reduce burnout and impulsivity. Post-session review is critical. It transforms experience into learning. Record every trade. Entry, exit, size, reason for trade, emotions during the trade, outcome. Review your plan adherence. Did you follow your rules? Where did you deviate and why? Analyze results objectively. Don't chase emotions. Was it a good setup? Was the loss a result of a bad plan or external randomness? Journal lessons learned. What will you do differently tomorrow? Celebrate successes too. Prepare for tomorrow. Identify potential setups, economic events, or lessons to focus on. Physical health and energy management. Fueling the trader's brain. Your body is the vehicle your mind drives. Neglect physical health and your cognitive abilities, emotional stability, and decision-making suffer. Key habits to incorporate. Regular exercise, at least 30 minutes, 3 to 5 times per week. Cardiovascular activity improves brain function, reduces stress, and enhances mood. Sleep hygiene. Aim for 7 or 9 hours of quality sleep. Poor sleep increases impulsivity, reduces attention span, and clouds judgment. Balanced diet. Prioritize whole foods, avoid excessive processed sugar, and maintain steady energy through balanced meals. Hydration. Dehydration impairs focus and increases irritability. Stress management. Use techniques like meditation, breathing exercises, nature, walks, or hobbies to lower chronic stress. Avoid stimulants, overuse. Caffeine or energy drinks can spike alertness temporarily, but lead to crashes and jitteriness. Use sparingly. Digital detox. Limit screen time outside trading hours to reduce eye strain and mental fatigue. Mindset, journaling and reflection. The growth engine. A journal is your secret weapon in building discipline and emotional mastery. It transforms vague feelings into concrete insights and helps you develop self-awareness, the foundation of a resilient mindset. How to journal effectively. Daily reflection. Write down how you felt before, during, and after trading. Track emotions. Were you anxious, excited, fearful, confident? What triggered those feelings? Process versus outcome. Focus on what you controlled, your plan, execution, rather than what you didn't. Market moves. Gratitude. Include 1 to 3 things you're grateful for daily. Gratitude boosts positivity and reduces stress. Set growth goals. What mindset habits do you want to improve? Patience, confidence, emotional detachment. Review past entries weekly. Identify recurring emotional triggers or behavioral patterns. Adjust your routine or mindset practice accordingly. Building your personalized routine. While this framework provides the foundation, your routine must be personalized to fit your unique lifestyle, trading style, and personality. Here's how to lay. Start building it. Audit your current habits. Write down your current daily activities related to trading, health, and mindset. Identify gaps and strengths. Set small, manageable goals. Don't try to overhaul everything overnight. Start with one habit, e.g., wake up at the same time or journal 5 minutes a day. Use triggers. Link new habits to existing routines. 4. Example, journal right after your morning coffee or review trades immediately after your last session. Track progress. Use a habit tracker app or simple calendar checkmarks. Adjust and iterate. Your routine should evolve with your progress and changing circumstances. Accountability. Share your routine goals with a mentor, friend, or trading community to increase follow-through. Real-life routine. Examples of pro traders to inspire your routine building. Here are some distilled habits from successful traders. The early riser. Wakes at 5:30 a.m. Does 10 minutes of meditation, light exercise, healthy breakfast, 20 minutes pre-market news scan. Writes trading intentions, reviews plan before market open. The structured breaker. Trades for 90 minutes, takes a 15-minute mindfulness break. Reviews trades briefly, then back to the charts with fresh focus. The night reflector. Journals every night, analyzing trades, emotions and lessons, then plans for the next day's sessions. The balanced trader prioritizes exercise 4 times a week, maintains a digital detox after market hours, and engages in hobbies like reading or music for mental reset. Overcoming common routine. Challenges building and maintaining a routine is not. Without challenges, procrastination. Start small to lower resistance. Even 3 minutes of journaling beats zero. Loss of motivation. Remind yourself why you trade. Keep vision boards or motivational quotes visible. Unplanned disruptions. Life happens. Be flexible. Resume your routine as soon as possible without guilt. Perfectionism. Don't let all or nothing thinking stop you. Missing a day is normal. Just keep moving forward. Emotional slumps. Lean on your support system or take mental health days as needed. How routine fuels long-term. Success routine turns daily discipline into compounding. Growth. Every day you show up and do the right things. You build mental toughness, sharpen your skills, and deepen emotional control. Over time, this edge separates consistent traders from gamblers or hobbyists. Success in trading is not about one big win. It's about the thousands of small, intentional actions done right repeatedly. Your bulletproof routine is your roadmap for this journey. Chapter 10. Think in years. From gambler to long-term trader. Imagine this. You sit in front of your screen, a trade just closed, and instead of obsessing over the tiny win or loss, your mind shifts to where you want to be 5 years from now. You see the bigger picture, steady growth, learning from every step, and building a career, not chasing quick thrills. This shift, from impulsive, short-term thinking to patient, long-term vision, is the most powerful transformation you can make as a trader. It separates those who burn out, chasing fast profits, from those who build lasting wealth and mastery. In this chapter, we will explore why thinking in years, not minutes, hours, or days, is essential to your success. We'll unpack the science of compounding, the dangers of burnout, and the mental strategies that help you stay committed through ups and downs. The curse of short-term. Thinking trading is a fast-paced world where news breaks in seconds and prices change by the millisecond. It's tempting to get sucked into the whirlwind of daily profits and losses, but short-term thinking has a dark side: emotional roller coaster. Daily trades become emotional events, causing stress, anxiety, and impulsive decisions. Chasing quick wins. You start to gamble, risking more to recover losses or grab fast money. Burnout. The mental exhaustion from constant market watching and emotional highs and lows leads to quitting or poor performance. Ignoring process. Focus shifts to outcomes. Did I make money today? Instead of process improvements. Loss of perspective. A single losing day can feel like the end of the world, overshadowing months or years of progress. When you think only in days or weeks, your mindset is hostage to volatility. You ride emotional waves instead of steering the ship. The power of a long-term mindset. Thinking in years is like switching from a narrow, shaky flashlight beam to a powerful, steady lighthouse guiding your entire journey. What does this mindset look like? Focus on compound growth. Instead of obsessing over daily wins, you aim for consistent, small gains that accumulate exponentially. Learning orientation. You value every trade as a learning opportunity, win or lose. Growth compounds as much as capital. Resilience. Setbacks are seen as temporary and necessary parts of the journey, not failures. Identity shift. You stop thinking, I trade, and start owning, I am a trader, a committed practitioner on a lifelong path. Goal clarity. You align trades and habits with bigger life goals, not just the next paycheck. Compound growth, your greatest ally. Many traders misunderstand the power of compounding because they only focus on quick wins or big leaps. Compound growth means small, steady gains multiply over time, creating exponential results. Consider this. If you grow your trading account by just 1% per day, after fees and costs, how much will you have after 1 year? Using the formula for compound interest, final amount sa current principal x, 1 plus daily return. Number of days. If you start with $1,000, after 1 day, 1 to 10. After 30 days, 1,349. After 365 days, had 37,800. That's the magic of compounding. Small, disciplined. Gains every day add up to massive wealth over years. But there's a catch. Compounding requires patience and discipline. You can't expect linear growth or ignore losses. Your mindset has to embrace consistency over speed, process over immediate profit, risk management to protect capital learning from mistakes and adjusting, avoiding burnout. The long game requires balance. The risk of burnout is high in trading because of emotional swings, screen time, and constant pressure. Burnout doesn't just hurt your performance, it threatens your entire trading career. To think in years, you must design your lifestyle for sustainability. Key burnout, prevention strategies. Set realistic goals. Avoid get-rich-quick schemes. Focus on incremental improvement. Schedule breaks. Take regular mental and physical breaks during trading hours. Limit screen time. Use technology wisely. Alerts, filters, and automated tools can reduce constant monitoring. Maintain a healthy lifestyle. Exercise, sleep, and nutrition fuel your brain and emotions. Develop interests outside trading. Hobbies, relationships, and learning outside markets keep you balanced and reduce stress. Have a support system, join trading communities, or find mentors who understand the journey. Practice mindfulness. Meditation or breathing exercises help manage anxiety and maintain clarity. Embrace losses as tuition fees for long-term success. When thinking in years, you view losses not as disasters, but as tuition fees you pay to learn the craft of trading. Losses are inevitable. Even the best traders lose trades. What matters is how you process and learn from these losses. Avoid denial. Accept loss quickly instead of rationalizing or doubling down emotionally. Analyze thoroughly. Review what went wrong and identify if it was a mistake in strategy, execution, or simply bad luck. Adjust and improve. Use insights from losses to refine your plan and mindset. Keep perspective. Remember that one trade is a tiny fraction of your long-term journey. This mindset reduces fear, builds resilience, and prevents emotional trading that sabotages success. Identity shift from I trade to I'm a trader. Language shapes thought. Instead of saying I trade, which implies a temporary or casual activity, say I'm a trader. This subtle identity shift creates a mental commitment that aligns your actions with your goals. When you own the identity, I'm a trader, you prioritize learning and growth consistently. Make disciplined decisions aligned with your values. See setbacks as part of your story, not the end. Commit to showing up every day, even when it's hard. Build habits and routines that support your trading career. Your identity becomes the anchor that holds you steady in volatile markets. Visualization. See your future self. Visualization is a powerful mental tool used by elite performers in every field. Imagine yourself 3, 5, or 10 years from now. What does your life look like as a successful trader? How do you feel when you manage your trades calmly? What daily habits have you mastered? How has your financial freedom changed your lifestyle? By vividly imagining your future self, you create a strong emotional connection to your long-term goals, which fuels motivation and discipline. Try a daily visualization exercise. Spend 5 minutes picturing your ideal trader's life, mindset, and routine. Plan your multi-year trading. Roadmap to think in years. You need a roadmap. Break your multi-year journey into manageable milestones. Year 1. Build a foundation. Develop and test your strategy. Learn risk management, create routines, and build emotional control. Year 2 to 3. Refine and grow. Scale your trades carefully, increase your edge, optimize routines, and deepen your market understanding. Year 4 to 5. Mastery and sustainability. Achieve consistent profitability, develop advanced strategies, mentor others, and balance trading with life. Set measurable goals for each phase and review them quarterly. Adapt as you grow, but keep your eyes on the multi-year horizon. Patience. The ultimate trader's virtue patience is often called the hardest trading skill. Why? Because it requires suppressing impulsive desires for instant gratification and trusting your long-term plan despite short-term uncertainty. Practicing patience means waiting for your setups without forcing trades, letting profits run and cutting losses quickly, sticking to your plan even when the market tempts you otherwise, allowing your skills and equity to grow steadily over years. Remember, every great trader was once an impatient beginner. Cultivate patience daily. It compounds just like your profits. Keep learning, keep growing. Markets evolve, and so must you. Thinking in years means embracing a mindset of continuous learning. Stay curious and humble. No trader knows it all. Read books, attend courses, and learn from other traders. Analyze your own data and journal insights. Adapt to new market conditions and technologies. Treat your trading career as a lifelong craft, not a sprint. This commitment to growth keeps your edge sharp and your mindset resilient. The legacy of thinkings. In years, finally, thinking in years connects you to a greater purpose. Trading becomes not just a way to make money, but a path to financial independence, personal mastery, freedom to live on your terms, inspiring others on their journey. By adopting a long-term mindset, you join an elite group of traders who build wealth steadily, protect their mental health, and contribute positively to the markets.